Learn to Trade the Stock Market, Part 61. What is an undervalued stock? An undervalued stock is a stock that is trading at a price lower than its intrinsic or fundamental value. In other words, the market price of the stock does not accurately reflect the true worth of the company as determined by its financial performance, assets, earnings potential, and other relevant factors. This situation often arises when the stock's market price has dropped due to various reasons, including market sentiment, economic conditions, company-specific issues, or investor perception. Undervalued stocks are often associated with low valuation ratios such as the price to earning ratio or the price to book ratio. The goal of investing in undervalued stocks is to benefit from potential price appreciation. As the market recognizes the company's true value and the negative sentiment subsides, the stock price may rise, providing investors with a profit. It's important to note that the determination of whether a stock is undervalued is not always straightforward and can involve subjective judgment. Investing in undervalued stocks carries risk, as the stock price might remain low for longer than anticipated, or the underlying company's situation might deteriorate further. Thorough research, analysis, and consideration of an investor's risk tolerance are crucial when evaluating undervalued stocks as potential investment opportunities. Learn to Trade the Stock Market, Part 62. Let's talk about thematic baskets today. Thematic baskets are the easiest and most cost-effective way to diversify your stock investments that are exclusively available in 2Trade Asia Plus. Thematic baskets are a group of companies with good income potential, as expert researchers at 2tradeasia.com have determined. For instance, if you want to earn income from real estate but you don't have the cash to buy rental properties, then you can just invest in real estate investment trust or REITs. For this, you can choose the REIT basket. Now, you can go to the thematic basket menu that's exclusively available when you sign up for a 2Trade Asia Plus account. And then, choose the REIT basket that you'll see in the list of thematic baskets. The REIT basket is composed of top companies with good valuations and optimistic growth potential. Currently, this basket comprises 5 REIT companies: Ayala Lands A REIT, Philinvest REIT, Robinsons Lands Commercial REIT, Mega World REIT, and Citycore REIT. When you invest in the REIT basket, which only has a minimum investment of 10,000 pesos, you'll be buying these 5 companies all at the same time. But later on, you can be more strategic and sell these companies individually. If you're too busy to do your own research, then thematic baskets is a good way to select the companies you can invest in on the stock market. Learn to Trade the Stock Market, Part 63. Let's talk about thematic baskets today. Thematic baskets are the easiest and most cost-effective way to diversify your stock investments that are exclusively available in 2Trade Asia Plus. Thematic baskets are a group of companies with good income potential, as expert researchers at 2tradeasia.com have determined. For instance, if you're looking for undervalued stocks that are stable and have good growth potential, then look for companies that are trading below their par value. For this, you can choose the Trading Below Par Value basket. Now, you can go to the thematic basket menu that's exclusively available when you sign up for a 2Trade Asia Plus account. And then, choose the Trading Below Par Value basket that you'll see in the list of thematic baskets. The Trading Below Par Value basket is composed of top companies with good valuations and optimistic growth potential. Currently, this basket comprises 4 companies in the banking and property sectors, namely Century Properties Group, East West Banking Corporation, Philinvest Land Incorporated, and the Philippine National Bank. When you invest in the Trading Below Par Value basket, which only has a minimum investment of 10,000 pesos, you'll be buying these 4 companies all at the same time. But later on, you can be more strategic and sell these companies individually. If you're too busy to do your own research, then thematic baskets is a good way to select the companies you can invest in on the stock market. Learn to Trade the Stock Market, Part 64. What are cyclical stocks? Cyclical stocks refer to companies whose performance and profitability are closely tied to the economic cycle. These stocks tend to follow the ups and downs of the general economy and are particularly sensitive to changes in consumer spending, business investments, and economic growth. Cyclical stocks are highly sensitive to changes in economic conditions. They perform well during periods of economic expansion when consumer confidence is high, unemployment is low, and businesses are investing. Conversely, they may underperform during economic downturns or recessions when consumers and businesses cut back on their spending. Examples include industries like manufacturing, construction, and the luxury market. Timing is crucial when investing in cyclical stocks. Investors often aim to buy these stocks at the start of an economic recovery, as this is when their earnings potential and stock prices may begin to rise. On the other hand, investors might consider reducing exposure to cyclical stocks as economic expansion matures and indicators of an impending downturn appear. As with any investment strategy, thorough research, understanding market conditions, and careful consideration of an investor's risk tolerance and goals is crucial when investing in cyclical stocks. Learn to trade the stock market, Part 65. Let's talk about thematic baskets today. Thematic baskets are the easiest and most cost-effective way to diversify your investments in the stock market, but are exclusively available in 2Trade Asia Plus. Thematic baskets are a group of companies with good income potential, as expert researchers at 2tradeasia.com have determined. For instance, if you want to invest in real estate but don't want to buy properties, then you can instead buy shares of major property developers with huge discounts on their net asset value. For this, you can choose the Property Sector Plays basket. Now, you can go to the Thematic Basket menu that's exclusively available when you sign up for a 2Trade Asia Plus account, and then choose the Property Sector Plays basket that you'll see in the list of thematic baskets. The Property Sector Plays basket is composed of top companies with good valuations and optimistic growth potential. Currently, this basket comprises four companies in the real estate sector: Ayala Land, MegaWorld, Robinsons Land, and SM Prime Holdings. When you invest in the Property Sector Plays basket, which only has a minimum investment of 10,000 pesos, you'll be buying these four companies all at the same time. But later on, you can be more strategic and sell these companies individually. If you're too busy to do your own research, then thematic baskets is a good way to select the companies you can invest in on the stock market. Learn to trade the stock market, Part 66. What are defensive stocks? Defensive stocks, also known as non-cyclical stocks, are shares of companies in industries that tend to remain relatively stable regardless of economic conditions. These stocks belong to sectors that produce goods and services that are considered essential or non-discretionary, meaning people continue to consume them even during economic downturns. Defensive stocks are often favored by investors seeking stability and consistent dividends, especially when economic uncertainty looms. They are best known for their stability. They often provide a consistent revenue stream and relatively steady earnings because the demand for their products or services remains consistent even when the broader economy is struggling. Many defensive stocks are associated with dividend payments. These dividends can provide investors with a regular income stream, making defensive stocks attractive to income-oriented investors such as retirees. Defensive stocks are found in various sectors, such as number one, utilities, or companies providing essential services like electricity, gas, and water. Number two, consumer staples or companies producing everyday necessities such as food, beverages, household products, and personal care items. Number three, healthcare companies, particularly those producing pharmaceuticals and medical services. And number four, telecommunication or companies that provide essential communication and media services. It's important to note that while defensive stocks are generally less volatile and offer stability, They may not provide the same level of capital appreciation as cyclical or growth stocks during economic booms. Therefore, the choice of defensive stocks often depends on the investor's goals, risk tolerance, and investment horizon. Defensive stocks can be valuable components of a diversified portfolio, providing stability and income while other sectors may be experiencing volatility. Learn to trade the stock market, part 67. What are speculative stocks? Speculative stocks are shares of companies that are considered to carry a high degree of risk and uncertainty. These stocks are typically associated with companies that are in the early stages of development, have unproven business models, operating in emerging industries, or are undergoing significant financial or operational challenges. Investing in speculative stocks can offer the potential for substantial rewards, but it also comes with a heightened level of risk. Speculative stocks are high risk, high reward investments. Investors are attracted to them because they offer the possibility of substantial returns if the company's prospects improve or if it becomes a market leader in its industry. However, they tend to be highly volatile and their prices can experience rapid and substantial fluctuations. This volatility can be driven by market sentiment, news events, and the company's own performance. Speculative stocks are often found in the small cap and micro cap segments of the market, where companies tend to have lower market capitalizations and may be less well established than larger companies. They may also have lower trading volumes compared to larger, more established stocks. This limited liquidity can make it difficult to buy or sell shares at desired prices. Speculative stocks can be particularly sensitive to news and events that affect the company or the industry in which it operates. Positive news can lead to rapid price increases, while negative news can result in sharp declines. Examples of speculative stocks might include startups in the technology sector, companies involved in cutting-edge industries like artificial intelligence, or companies with uncertain financial prospects that are attempting a turnaround. Investing in speculative stocks requires thorough research and due diligence. Investors should carefully assess the company's business model, management team, competitive position, financial health, growth potential, and industry dynamics. Due to the inherent risks associated with speculative stocks, investors are often advised to limit their exposure to these stocks and maintain a diversified portfolio that includes a mix of asset classes, including more conservative investments. Learn to trade the stock market, part 68. Let's talk about buy and hold investing strategy today. Long-term investing is an approach where investors purchase stocks with the intention of holding them for a long time, usually several years or even decades. The main goal of this strategy is to benefit from the long-term appreciation of the stock market. Buy and hold investors believe that over time, the stock market will rise despite short-term fluctuations and market volatility. This strategy is relatively passive as it involves buying a diversified portfolio of stocks or index funds and holding until you need the money, usually once a person retires. Proponents of buy and hold often point to historical data, which shows that the stock market has generally trended upward over the long term, despite recessions, wars, and pandemics. Many buy and hold investors focus on dividend-paying stocks to generate regular income from their investments. Then, they reinvest the dividends and capital gains back into their portfolios to benefit from compound growth. It's important to note that the buy and hold strategy requires discipline and a strong stomach, as investors may need to endure market downturns without panic selling. While this approach has historically produced positive returns over the long term, it doesn't guarantee success, and individual stock performance can really vary. As with any investment strategy, it's crucial to research and choose your investments carefully and periodically review your portfolio to ensure it aligns with your financial goals and risk tolerance. Additionally, your investment horizon should match your financial objectives, as this strategy may not be suitable for short-term financial needs. Learn to trade the stock market, part 69. Let's talk about value investing today. Value investing is an investment strategy that involves selecting stocks or other assets that appear to be trading at a discount to their intrinsic or true value. This approach was popularized by Benjamin Graham and his student Warren Buffett and is based on the belief that markets can sometimes misprice securities, leading to opportunities for investors. Value investors attempt to determine the intrinsic or fundamental value of a security, which is often calculated based on factors such as earnings, book value, cash flow, and other financial metrics. The goal is to estimate what the asset is truly worth. Value investing is typically a long-term strategy. Investors who follow this approach are willing to hold their investments for several years until the market recognizes the asset's true value. Value investors rely heavily on fundamental analysis, examining a company's financial statements, earnings, revenue, debt levels, management quality, and competitive positioning to assess its true worth. Value investing can require patience as it may take time for the market to recognize the value of a particular asset. Investors must be prepared to wait for the market correction. It's important to note that value investing is not a guaranteed way to make money, and not all value stocks will perform well. There are risks associated with this strategy, including the possibility that the market may never correct its valuation error, leading to sustained underperformance. Additionally, value stocks may face unique challenges such as business model disruptions or declining industries. Warren Buffett, one of the most successful value investors of all time, has emphasized the importance of patience, discipline, and a thorough understanding of the companies you invest in. He famously said, "The stock market is designed to transfer money from the active to the patient." Learn to Trade the Stock Market, Part 70. Let's talk about dividend investing today. Dividend investing is an investment strategy that focuses on selecting stocks or other assets with the primary goal of generating a consistent stream of income through dividend payments. Dividends are typically cash payments made by a corporation to its shareholders out of its profits or retained earnings. These payments are usually made on a regular basis, often quarterly. The main objective of dividend investing is to create a steady stream of income. Investors often rely on these dividends to cover living expenses, fund retirement, or reinvest in additional shares of the same stock. The dividend yield is a crucial metric for dividend investors. It is calculated by dividing the annual dividend payment by the stock's current market price. A higher dividend yield typically indicates a more significant income potential. Many dividend investors seek stocks from companies that have a history of consistently increasing their dividend payments over time. This is known as dividend growth investing and can help investors combat the eroding effects of inflation. Dividend investors often prefer stocks from well-established companies with a history of financial stability and profitability. These companies are more likely to maintain their dividend payments even during economic downturns. Dividend investing is often considered a long-term strategy. Investors who follow this approach may hold their dividend-paying stocks for many years or even decades to benefit from compounding returns. Many dividend investors choose to reinvest their dividend income back into the same stocks or into additional shares, which can accelerate the growth of their investment over time. It's important to note that not all companies pay dividends, especially younger or growth-oriented firms that reinvest their profits into expanding their businesses. Additionally, the yield and sustainability of dividends can vary from one company to another. Before investing in dividend stocks, investors should conduct thorough research to assess the financial health and dividend history of the companies they are interested in. Learn to Trade the Stock Market, Part 71. Today, we're diving into an essential topic for stock trading: risk management. So, what's risk management? These are safety measures that help protect your money when you're trading stocks. Imagine the stock market is like a roller coaster. It goes up, down, and sometimes it flips around. But don't worry, risk management is your seatbelt. It keeps you safe during the ups and downs. The first key to risk management is diversification. It's like having different flavors of ice cream. Don't put all your money into buying just one flavor. Spread it out and buy companies from different stocks or sectors. Next is having a stop loss order. This is your emergency button. Decide how much you're willing to lose, and if the stock falls to that point, your stop loss order will sell your shares automatically so you don't lose more money. And remember to never go all in. Don't risk all your money on just one trade. Lastly, keep learning. The more you know, the better you can manage your risk and enjoy the roller coaster ride. You can watch videos, read books and articles online, and stay informed. So there you have it, risk management. Be smart, stay safe, and have fun on your stock market adventure. Learn to trade the stock market, part 72. Today, we're diving into something super important for trading, the psychology behind it. So, what's that all about? Well, it's like understanding how your mind works when you're trading stocks. Here's the deal. Your emotions can be your best friend or your worst enemy when trading. When you take profits, it's like a party in your brain. You feel super confident. But when things go south, it's like a storm cloud over your head. Fear and panic kick in. So, what's the trick? Keep your cool. Take deep breaths, focus, be objective, and sometimes you need to step away when you're stressed already. The key is to have a game plan. Write down your goals and your strategies for when to buy or sell a stock. Then, follow it objectively. Remember, trading is not just about numbers, it's about your mind too. So, be the boss of your emotions, stick to your plan, and enjoy the trading adventure. Learn to trade the stock market, part 73. Today, we're exploring the concept of a risk-reward ratio. So, what is this ratio? Imagine it's like a potion recipe for successful trading. When you trade, you're like a scientist mixing ingredients. One ingredient is risk, and the other is reward. All trades have risk, so the key is making sure that your reward is greater than your risk. Let's say if a trade goes wrong, you lose 1,000 pesos. But if it goes well, you'll earn 2,000 pesos. That's a good risk-reward ratio of 1:2. To have a good risk-reward ratio, the key is to plan it out. Do technical and fundamental analysis to determine how much your possible loss and potential profit will be if you trade a particular stock. And that's the risk-reward ratio, your secret recipe for trading success, where the reward is the magical potion you're aiming to brew. Learn to trade the stock market, part 74. Today, we're talking about the importance of having a trading plan. So what's that all about? Think of it as having a treasure map for your trading adventure. When you trade, you're like an explorer. A trading plan is like your map, showing you where to go and how to get there. Without a plan, it's like setting off on an adventure without knowing your destination. It can be scary and stressful. But with a plan, you have clear goals and strategies, and you can prepare for whatever challenges that you might encounter. In the stock market, a trading plan helps you decide what to buy, when to sell, and how much risk you're willing to take. It is your game plan. Additionally, it helps to write it down. Don't store everything in your head. Write down your goals, your strategies, and your trading rules. Keep a journal of your trading journey. This way, you can look back and learn from your mistakes, but also you can see what worked well in the past so that you can do it again. So there you have it, a trading plan. It is your compass, guiding you through the trading seas. With it, you're better prepared for your adventure. Learn to trade the stock market, part 75. Today, let's chat about something super important when you're putting money in the stock market, and that is protecting your trading capital. What's that, you ask? Well, it's like protecting or keeping your piggy bank safe from breaking. When you trade, your trading capital is your stash of money. It's the money in your account, and you have to keep it safe and make sure that it doesn't run out. If you don't protect your trading capital, it's like dropping your piggy bank and breaking it. And that's not good. When you protect your capital, you're not just keeping it safe, you're also allowing it to grow. So now, how do you protect your trading capital? First, you can use a stop loss when trading. It's like a safety net for your money. If things go south, it stops the trade and you don't lose a lot of money. And another one is having a trading plan. Write down your goals, your strategies, and how much risk you're willing to take for each trade. Having a trading plan helps you stay focused and be objective with your trading decisions. There are a lot of other strategies you can do to protect your trading capital, but that's it for now.